Hello, everyone. Thank you so much for joining us. Today's episode is Tariff Talk. It is an industry insight on exploring tariffs, what they are, and how they affect you. So, just a quick start about us. Remington Park is a family office that lends money for investment real estate. We finance projects from our balance sheet and source additional financing for our borrowers to ensure their projects are a success. Our mission is to preserve and grow the wealth of our generational investors. I'm Parker Schultz, and he is Michael Zhao. So a tariff is a tax imposed by a government on goods and services entering or leaving a country. So it's typically applied to the imports to raise their cost and to protect domestic industries or generate revenue. So Trump's 2025 policy, for example, has been a 10% tariff on all imports, meaning a $100 item from abroad would cost 110, which is supposed to nudge buyers towards US-made alternatives. This whole controversy or event was sparked from Liberation Day, which was President Trump's latest tariff announcement, which kicked off on April 2nd, marking a significant shift in the U.S. trade policy. The announcement included a 10% baseline tariff on all imports from any country, which was set to take effect April 5th. And additionally, with a set of reciprocal tariffs were announced where they imposed higher tariffs, including 34% on Chinese imports and 20% on the European Union starting April 9th, which is today. This is from Thomson Reuters Tax and Accounting. This image here shows tariffs charged to the U.S. on the left column, and on the right column, the USA's discounted reciprocal tariffs, and kind of gives you an indication of how much these vary from country to country, some being as low as 10%, some as high as 97%. And what this resulted in the market was a short-term flash crash followed by a flash recovery over a 5-day period. This picture was taken today, Wednesday, April 9th at the market close, and you'll see the S&P is down by 0.25%. So essentially zero net loss or gain, although a lot of turbulence during this time period. And we've seen some pretty interesting market trends. Certain companies have actually skyrocketed through this turbulence. Things like NVIDIA, Intel, Tesla, Ford, Palantir, and Apple have made gains anywhere from 10 to 20% over this period, which I think kind of gives an indication of where money may have been moving around. And now when we look at the market in the long term, the S&P 500, despite this turbulence, has still had very strong performance. Over the past 5 years, you would be up almost 95% on an investment, as we were at all-time highs around the 6,000 mark very recently. And so there's been a response from the Trump tariffs. This is from the New York Times. You'll see certain countries have responded by trying to negotiate. Others offered some concessions. Some retaliated, increasing their tariffs, and some took no action at all. So there's a little bit of a mixed bag as this was applied to our global market. Some people, like Kevin O'Leary from Shark Tank, thinks some of these tariffs are not enough. China currently is facing a 104% tariff. Mr. Wonderful from Shark Tank advocates 400% based off his experience working with China. This may seem extreme, but sharks, he does have an offer for you. And now today, Wednesday, April 9th, Donald Trump posted on X basically saying he's authorized a 90-day pause. And this was the indicator for our flash recovery, which substantially lowered the reciprocal tariff during this period of 10%, effective immediately. In essence, in simplified language from the AP, Trump pauses steeper tariffs for most countries while hiking levies on China. So essentially now, instead of a global trade war, it's really a 1v1. Visualized here by some AI art, it is really China versus the United States in a tariff battle to try to fix their trade deficits. And now we look at how treasury yields are effective. There's been turbulence in the stock market, but there are many other assets that are involved in the financial market as a whole. You'll see short-term treasuries ranging anywhere from 3 months to 12 months have come down substantially, almost 100 basis points from where they were a year ago. And a decrease in treasury yields means an increased perception of that security, as there is a flight to these more secure assets. Lower treasury yields can also be an indicator that interest rates may follow, as it is the price of that capital and the expected returns. We'll look at the Federal Reserve rate, and you'll see that the federal funds rate and the Federal Reserve target and the prime rate are all down 100 basis points from where they were a year prior, meaning that money is more affordable. And so what does this mean for real estate? We saw some turbulence in stocks, and actually some is probably an understatement, but there has been investment commitments into the U.S. of nearly $3 trillion since Trump took office in 2025. Notably, the UAE is investing 1.4 trillion, but we see companies like Apple investing 500 billion, Nvidia in making investments, Taiwan Semiconductor, Johnson and Johnson, Eli Lilly from the biotech sector, Merck, and even aerospace making very significant investments. So, although there may be turbulence abroad in foreign markets and global companies, there seems to be certain companies that are making a headstrong investment into the US. And for me, when I think of what this means for real estate, is it might be a new era of this investment. It's been rather quiet for since COVID, I would say, in investment and actually creation of new products into the United States real estate market. And this boom could be something that will come back and actually strengthen the weakened office market, and most importantly, be a very strong growth for the industrial market as we move to ideally reshore a lot of these companies onto the US. But Michael, that's my opinion on this. What do you think about all this stuff that's been going on?
Well, first of all, let's be clear that we don't have an inverse yield curve. In fact, it's kind of healthy. And so for us to be able to say that the economy is falling into a recession, bond market might disagree with you, as we do not have an inverse yield curve at this point in time. However, with the lack of stability currently in the equity market, it's been strange, as when stock market is up, the bond market is down, and when the bond market is down, the stock market is up, traditionally speaking, because the money has always got to be invested somewhere else. We actually see it across the board in a very unique fashion, not knowing exactly what is going on. President Trump telegraphed when the tariff were to be put into place, freedom time for us. Well, when you telegraph that out there and the stock market reacts accordingly, guess what it's going to do? Not only is it going to either buy or sell, but the options traders and the hedge funds will also act accordingly as well. And what happens is when you're planning on the economy to fail and the prices to come down, well, when the stock market roars its roaring head, well, the only way to cover those shorts in the options market is to go buy more. It's no surprise that when everybody was expecting the market to drop, guess what? The market is doing the opposite. Not just because of confidence in the American economy. It's actually mostly based upon short sell salvation. And that means very similar to what happened with GameStop and the meme stock trades. Well, that's what's going on right now, because the hedge funds are the only organizations which have the liquidity and the capital to cover their shorts and buy trillions of dollars of securities in one fell swoop. Nvidia going down by 3%, 4%, and 1 hour later, up 7% for a 10% swing. Only hedge funds have the liquidity in order to cover their shorts to see this type of market action in the stock market. And let's also be clear. The United States of America is a consumer nation. And as a consumer nation, they're going to be buying versus the rest of the world. China's still being considered somewhat of a third world country, not being the consumer, but the producer. You ever watch Shark Tank? Like we had Kevin O'Leary talking about what's going on with what's unfair and what's fair. Let's be clear. We may not say it, but on Shark Tank, it's absolutely clear. You want cheap labor and you want to try and profit as much as a small business that's starting out trying to sell your business on Shark Tank, you're going to go to China, Sri Lanka, India, Pakistan. And guess what? Those just happen to be the countries with that, Vietnam even, the highest amounts of tariffs. Whereas if you look at Chile, Colombia, 10% tariffs. So we can say that as a nation, it may be fair or unfair, but the truth in the tariffs are absolutely clear. We're sending our services abroad as far as labor is concerned, and King Dollar is still spending money because the consumers are spending money. Are we going to head into recession? Wall Street will tell you yes, but the bond market, at least verbally, they'll tell you yes, but the bond market is not performing as such. When it comes to real estate, we may be looking at lower interest rates temporarily. It's gone up, it's gone down, but let me tell you right now, I think that we're going to see lower interest rates in the very near future, because at the end of the day, those tariffs are still going to affect the pricing, the inflated values of wages across the nation, and for the short term, going to cause a reduction of corporate profits. And when we see a reduction of corporate profits, we typically see lower mortgage interest rates. We also see an increase of purchasing power as a result, with all the sideline money that's on there. real estate looks very positive in the short term over the course of the next 12 to 24 months. So let's not be so scared on what is happening with tariffs. Let's be confident that no matter what your purchasing power is, you buy to live. And if you're not buying to invest and you're buying to live, it doesn't really matter, because at the end of the day, these swings over a 1 hour, 1 day, 1 week term is not going to affect your living capacity over 30 years.
Well said indeed. Well, thank you everyone for joining us. That's all we have for this episode. And what we love to do is continue the discussion. And if you have something to say, or if you have a contrary opinion, we'd love to hear it. Please put a comment down below. We'd love to get back to you and keep the discussion rolling for there. But that's all we have for today. Thank you so much for your time. I'm Parker Schultz. He's Michael Zhao, and we look forward to talking to you next time.